In the summer of 1997, Thailand still looked rich. Construction cranes were above Bangkok. Credit was easy. Foreign money was still treated as a vote of confidence. The baht had been held near 25 to the dollar for years, and that stability had trained an entire business class to believe a fatal thing, that borrowing in dollars was almost the same as borrowing in their own currency. It was not a Terry. Then the clock ran out. On July 2, 1997, Thailand abandoned the peg and let the baht float. What had been sold as stability turned into a repricing event so violent that balance sheets broke before people finished breakfast. A local currency income stream stayed local, but a dollar debt did not. Once the baht fell, the debt burden exploded in domestic terms. That is the first payoff in this story. The crisis was not mainly about stocks or sentiment or some mystical loss of confidence. It was about a simple mechanical trap. Private firms had financed long-lived property and industrial bets with short-term foreign borrowing. The central bank tried to defend a promise it did not have the usable dollars to honor. By the time the public heard float, much of the real damage had already been done in the reserve book. And here is where the official version starts to break. Because crises like this do not strike everyone at once. The public meets the collapse at the exchange booth, the bank queue, the refinancing desk. The connected meet it earlier through tighter credit windows, reserve rumors, offshore banking channels, and the quiet disappearance of certainty. Thailand's liberalization drive, including the Bangkok International Banking Facility established in 1993, created exactly the kind of foreign currency plumbing that made the boom larger and the exits more unequal. In this autopsy, that is the real question, not why the miracle ended, why some people were already halfway out when everyone else still believed the guarantee. The crisis begins years before the panic. During the late 1980s and early 1990s, Thailand and South Korea were held up as proof that rapid industrial growth, disciplined policy, and open capital markets could coexist without major strain. Factories expanded, property values rose, foreign lenders saw fast growth and assumed safety. Local borrowers saw lower dollar interest rates and assumed efficiency. Both sides mistook a refinancing machine for durable wealth. Thailand is the cleaner autopsy. The boom was increasingly financed through foreign borrowing, much of it short-term, while the assets being built with that money were anything but short-term. Office towers, industrial parks, speculative real estate, and ambitious corporate expansions do not mature in 90 days. But a large share of the funding did. That is the first structural fracture. Borrow short, build long. The second was even deadlier. Borrow in dollars, earn in baht. As long as the exchange rate stayed fixed, both fractures were invisible. Once the exchange rate moved, both became lethal at the same time, and policy helped make that trap look respectable. Thailand's Bangkok International Banking Facility, established in March 1993, was meant to deepen international banking activity and improve access to foreign funding. In practice, it widened the pipe through which domestic borrowers could tap offshore credit more cheaply. That looked modern. It also meant more firms took on foreign currency exposure, while assuming the baht's link to the dollar would hold. The record is explicit on this point. With the exchange rate treated as stable, firms accumulated large unhedged positions. South Korea followed a different road into the same trap. Its crisis was less about a property bubble than about highly leveraged conglomerates, weak financial supervision, and a rising dependence on short-term external funding through banks and merchant banks. By 1996, external debt had risen sharply, and the share of that debt maturing in the short term had become dangerously high. In September 1997, Korea's short-term debt was reported at $104.8 billion, while official foreign reserves were only $30.4 billion. That is not a cushion. That is a countdown. This is the part most people miss when they look back on the Asian miracle. The visible economy looked strong because the income statement still looked strong. Exports were real. Construction was real. Rising land prices felt real. But underneath that, The balance sheet had been colonized by dollar obligations that could only be safely carried if rollover remained easy, and the peg remained credible. Once either one weakened, prosperity stopped being a wealth story and became a funding story. And funding stories end suddenly. A fixed exchange rate only looks like a promise from the outside. From the inside, it is a continuous test. Every day, the central bank is asked the same question by the market. If I bring you local currency and demand dollars, can you still pay? If the answer is yes in size and for long enough, the peg survives. If the answer is no, the peg is already dead. The announcement just comes later. That is why a currency crisis often feels sudden to the public and obvious to professionals. The public hears the speech. The market watches the reserve drain. This is where the confidence story becomes arithmetic. Thailand had trained borrowers, banks, and foreign lenders to think of the baht's link to the dollar as a national guarantee. That belief lowered perceived currency risk. It encouraged firms to borrow in dollars without hedging. It made lower foreign interest rates look like free efficiency. But a peg is not protected by rhetoric. It is protected by liquid foreign exchange and by the political willingness to sacrifice domestic conditions to defend the rate. Once either one weakens, the guarantee stops being a guarantee and becomes a bet. By the mid-1990s, traders could see the bet was deteriorating. Thailand's growth was slowing. Property weakness was becoming harder to hide. External liabilities remained large. And crucially, the pressure point was not total wealth in the economy. It was the relationship between short-term foreign claims and usable reserves. The BIS later showed how exposed these systems were by comparing short-term external debt to reserves. For Thailand, that ratio moved from 89% at end 1993 to well above 100% by 1996, meaning the claims coming due were overtaking the official buffer meant to defend the system. That is a pattern interrupt at the center of this episode. If a central bank promises a fixed exchange rate, but the stock of dollars behind that promise is shrinking while the demand for dollars keeps rising, who is lying? The bank or the math? Institutional traders did not need clairvoyance. They needed a spreadsheet. Once they concluded, the peg was politically cherished, but financially underarmed. The trade was straightforward, sell baht forward, borrow baht to sell against dollars, or otherwise position for a break in the regime. The attack was not magic. It was an attempt to force a central bank to prove it had enough dollars to absorb the sowing pressure. If the central bank defended aggressively, it burned reserves and tightened domestic liquidity. If it stepped back, the peg snapped. Either outcome damaged the economy. This is why speculation is often used as a moral cover. It makes the crisis sound like an external assault, but speculation only becomes decisive when the internal structure is already brittle. The trader is not creating the mismatch. He is locating it faster than the public narrative can conceal it. By late June 1997, the defense of the baht was no longer really a defense of the economy. It was a defense of appearance. That distinction matters. A central bank can spend reserves to slow a panic, but if the underlying mismatch remains, short-term dollar claims against a domestic system that cannot generate dollars fast enough, intervention does not solve the problem. It only changes the sequence of who discovers the truth first. The public still sees the official exchange rate. Dealers, foreign banks, and politically connected borrowers see the growing strain in funding markets, rollover terms, and liquidity conditions. The illusion survives longest at street level. Thailand fought hard before it yielded. After repeated speculative pressure, the Bank of Thailand abandoned the peg on July 2, 1997, and let the baht float. The move was not a controlled modernization. It was the point at which the authorities could no longer maintain the previous regime. IMF and IMF history accounts both date the break to July 2nd, and one IMF history notes that the baht closed the day down by nearly 17% in offshore trading. The hidden violence of that day was not just the visible devaluation. It was what the devaluation revealed about the reserve book. During 1997, the Bank of Thailand had intervened heavily in both spot and forward markets. That matters because official reserves can look larger than usable reserves when a central bank has also built large forward obligations promising to deliver dollars later. In other words, the state can appear liquid on paper while having already spent tomorrow's dollars defending yesterday's rate. That is why a peg often looks intact right up until it fails. The market is not looking at the headline reserve number alone. It is trying to estimate what part of that stock is already spoken for. This is the 20-second recap of the day the dollars effectively ran out. For months, Thailand bled reserves to prove the bot was safe. Firms kept assuming the guarantee would hold. Traders kept testing it. Every defense operation consumed more ammunition. Then, on July 2nd, the theater ended. The peg was dropped, the bot fell sharply, and every borrower who had treated dollar debt as harmless discovered the same thing at once. The exchange rate risk had not disappeared. It had merely been delayed until it was too large to survive. And once that happens, the crisis leaves the dealing room and enters ordinary life. A company with revenues in baht and debt in dollars does not experience devaluation as an abstract macro event. It experiences it as payroll stress, canceled orders, frozen credit lines, forced asset sales, and layoffs. Finance companies begin to fail. Rehabilitation plans are demanded. Liquidity becomes permissioned. The people who need dollars most badly suddenly have the least access to them. That is when a currency event becomes a social event. This is the part where popular retellings usually become lazy. They imply that the elites all received a dramatic phone call, emptied the country, and left the public holding the bag. Sometimes there were rumors, private warnings, and relationship advantages, but the deeper forensic truth is more important than any single anecdote. The people at the top did not need perfect foresight. They needed better plumbing. In a peg system under stress, exit is rarely equal. The ordinary saver holds local deposits, local wages, local property, and local assumptions. He discovers the danger only when the line forms at the bank, at the exchange counter, at the refinancing desk. But a full-scale connected conglomerate, a senior banker, a family office, or an exporter with foreign accounts lives in a different time zone. They may already have dollar receivables. They may borrow abroad directly. They may keep balances offshore. They may hear, days before the public, that rollover conditions have changed, that reserve defense is becoming desperate, that swap markets are signaling panic, that domestic institutions are quietly tightening access. That is the asymmetric exit, not always a dramatic escape. Often a series of smaller moves made before the language of crisis becomes official. Convert more working capital into dollars. Prepay an external obligation before the exchange rate moves. Delay bringing export earnings home. Shift liquid balances into Singapore, Hong Kong, New York. Reprice contracts. Refuse new local currency exposure. Hedge what can still be hedged. Sell the domestic asset that still has a bid. Ask for collateral in harder money. By the time the public hears reassurance, the upper tier has already started behaving as if reassurance no longer matters, and that behavior compounds the collapse. Because every early mover who exits the local currency increases pressure on the reserves, on the banking system, and on everyone beneath them. The rich do not merely survive the regime change. Their survival often accelerates it. The public thinks the system is failing because panic spreads. In reality, panic spreads because those with the best information have already begun to act. This is why crises feel unfair even when they are mathematically inevitable. The losses are socialized through inflation, layoffs, credit contraction, forced sales, and collapsing purchasing power. The protection is privatized to access to information, access to offshore channels, access to lawyers, access to foreign banks, access to time. And time, in a currency break, is everything, because a person who converts before the peg fails preserves optionality. A person who converts after the peg fails is simply paying the new truth. So what does the forensic record leave you with? Not a prophecy, a checklist, If your country advertises exchange rate stability as a substitute for structural strength, start with the reserve question. Look at official foreign exchange reserves. Then ask the harder question, how much of that is truly usable after short-term external liabilities, swap commitments, and forward obligations are considered? In past crises, that gap between headline reserves and usable reserves was where the lie hid. Then check the private sector. Are firms borrowing in foreign currency while earning in local currency? Is growth being financed by short-term external funding? Are banks and large corporates assuming rollover will always be available? If so, you are not looking at stability. You are looking at a system that remains calm only while outside money keeps renewing the illusion. That was the pattern in Thailand. It was the pattern in Korea. And it is the pattern that turns prosperity into a trap. The survival lesson is restrained, not romantic. Hold part of your liquidity in instruments and jurisdictions that do not depend entirely on one domestic policy promise. Understand your direct and indirect foreign currency exposure. Distinguish nominal wealth from usable wealth, and never assume an official guarantee is stronger than the balance sheet behind it, because when the peg breaks, there are only two kinds of people left in the system: those who prepared for convertibility to disappear, and those who discovered too late that their wealth was only local.